All right, fantastic. So this is the meeting of the Athens-Clarke County Deferred Compensation Board. Um, we do not have quorum at this time for us to do official business, but we do have a couple of important presentations of information that we are going to go ahead and proceed with. Um, I also want to go ahead and welcome David Smiley, who's going to be joining us as our community representative that has been vacant for quite some time. Though we will not be a voting member at this meeting, it's very excited to have you with us and have you working with us over the next couple of years. So thanks for being here.
Thank you. I look forward to being of service.
Fantastic. And so if I am looking at this correct, the first thing that we can do, non-business related on our agenda, is if we go into discuss it, at least is the update on election of employee representatives. I think we have 2 nominations, correct?
Correct. We had 2 applications, Harrison Daniel and John Spagna. And so John is still serving his first term, and we will, since we don't have any opposition, he will start a second term on July 1st. Harrison Daniel comes to us from the police department. He is a captain over there, and we'll welcome him on July 1st as well. If it's okay with the attorney's office, I will let the 2 of them decide which one will serve a 1-year term and which one will serve a 2-year term, so that we can maintain those staggered terms. In addition, Dennis Smiley will take his official position on July 1st, and it will run for 2 years, after which time he'll be eligible for reappointment if he reapplies. So
Fantastic.
we are on track for some regularity as far as terms go.
That's good. We'll have a full roster. So thank you, John, for being willing to serve again, and we look forward to having Captain Daniel with us too during July 1st.
You're welcome.
All right, so then we can move on to our first bit here. We're going to get an update on the investment policy statement development that we went ahead and moved forward with at the last meeting.
Yes, and I think Jeff Hale had a comment.
I just had a question as to the status of the community representative. I may have missed that, and whether this is the person that will have some market experience, I guess.
That's going to be Mr. Dennis Smiley, who's with us here today.
I missed the beginning.
Hi, Jeff. How are you?
Sorry, sir. Good to see you.
Yes,
Now
I
I'm
am
straight.
not. I am not Janet. My wife has captured this ID somehow, and I don't know how to get rid of it. So
I'm going to blame my apparent confusion on that.
but I can be Janet if you need me to be.
Fantastic. Awesome. All right, let's go ahead and move forward. We'll get the update on the policy statement development.
Okay, I spoke with Paul over at Aon, who is our Aon representative, and will be in charge of this engagement. And you guys in the last meeting approved by unanimous vote that we would move forward with them developing an investment policy statement. So we have issued a request or a requisition to engage them based on the statement of work, changing the acceptance date of that statement of work to March 10th, 2020. So that process will move forward, and we'll be able to give you guys drafts of that IPS as they come in. Hopefully finalize that by the next meeting.
Okay, that's perfect. Thank you.
And
right.
Commissioner, if I could ask just a quick question around that, because Laura, you're going in and out for me just a little bit. I just want to make sure I captured that correctly. I know that you said that Aon is going to be working on the IPS, but I think I also heard, have you engaged Aon for ongoing services in an investment consulting capacity?
Yes. They are our actuary for the pension board, for the pension
Right.
fund. And then they also advise us, in this regard, and they're helping us with our, focus groups and employee surveys that we've been conducting in case we want to make any modifications to our retirement offerings.
Okay, perfect. Thank you.
All right. Well, we'll move on to our guests we have with us with AIG for our annual plan review. So whoever is going to kick us off there, thanks for being with us, y'all. We got a full house.
Thank you, Commissioner Denson. I will go ahead and get started. And I met most of you prior, and obviously I know Jeff and Tracy and Laura, but in the way of formal introduction, my name is Carrie Jenkins, and I serve as the relationship manager for your retirement plan. So essentially, the liaison between you and what you need and AIG Retirement Services, just making sure that we are helping you manage your plan and get your employees ready for retirement. So with that said, I actually wanted to kick off the meeting with a little bit of an informal discussion as it relates to having outside vendors or non-essential vendors on campus as far as returning to the office engagement, right? We are having a lot of those conversations right now with our clients. We have a formal date in place of September 1st, right, in terms of having, both our financial advisors, even myself and Roger, in terms of managing the relationship and meeting with our clients on site. So our return to the on-site work is September 1st, but we want to get a sense too from you in terms of what you're hearing from employees, what your policy is currently. I can tell that a lot of you are still working remote, but just wanted to get a sense from you in terms of how you plan to proceed in the upcoming months, and then talk you through a little bit about what we are starting to do in terms of bringing folks back on site.
Manager Williams or Jeff, do y'all have any input on what the policy is looking like for moving back on site? Or
yes, thank you. So we've been watching closely, and our original intent, Commissioner, was to hold a employee vaccination event, as you know, and it was going to be the Johnson & Johnson vaccine. And literally 3 days before it was to take place, there was some pause on that. And so we canceled that. I will say that we did not have a lot of signups at the time, which we can't divine. We hope that means most of the people had already gotten them. And I think we all know anecdotally that access now is quite open and easy. I bring that up because that event was at the time going to be in mid-April, and we were thinking, or mid to late April, and we were thinking 30 days out from that, once the vaccine had taken the full effect, we would begin a transition back into the workplace. With that, we delayed a couple of weeks. So what we're looking at right now, to answer your question after all that, is in a couple of weeks, June 15th, we're going to ask folks to begin transitioning back into the workplace. We've asked department directors to, we run a very wide and varied operation, and chemists and police officers. So we've asked department directors to talk to us about some special conditions or issues. We want to try and work with employees as much as possible. We also recognize that there's a morale issue, that some folks can be seen as, not working when they're at home and not in the office. And so we want to try and be as uniform and consistent as possible. All that being said, by July 1st, we hope that folks are back in the workplace for the most part, and that we're open to the public.
Okay. Yeah, that sounds good. Thank you for the update. And, from our perspective, what we're starting to do, as I mentioned, we're gauging what our client's position is and what their need is in terms of having particularly the financial advisors back on site, right? And so currently, we are making some exceptions where asked. I will tell you that we have a very stringent process in place for having any of the employees back on campus with our clients, which include, if we decide to do that, it includes a daily wellness check. It also requires that, they wear a mask, regardless of, whether or not the client that they're visiting with is masked. And certainly the financial advisor would have to be, I guess, first and foremost, would have to be comfortable, right, with that engagement. So just really wanted to, get you up to speed on that as you start your process and your journey to get it in terms of getting your employees back on site. And if you're hearing the need from your employees or participants that they need to meet face-to-face with a financial advisor, please share that with myself and Roger and David even, right, so that we can make sure that we are, we are meeting with those employees that need consultation. Okay. Roger, any additional comments with that? I know you're close to that as well.
We are working very closely internally right now. Carrie, you said it very well. We've got a lot of internal policy that's being developed, and we want to very closely partner with you so that as we all begin to transition back, that we're completely in sync and we're honoring any kind of requirements that you have there. That's our number one concern. And then, of course, we have our own internal as well. So as we move forward, we'll continue to collaborate pretty closely and looking forward to the point that David will begin to work back with your employees on site again.
Perfect. Thank you, Roger. And so before we actually jump into the plan review demographics and then specifically the investments, because we wanted to spend a fair amount of time on that, one of the things that I actually had on the list was the investment policy statement. So check on that. Thank you for that update. The other thing that I wanted to check in on earlier this year, we did a plan document review, and I know, Jeff, you had some conflicts at the time that we were doing that, but Laura, I wanted to check into to see if there was any traction on terms of some of the changes that we discussed and proposed as far as the plan documents.
Laura, this is Tracy. If you want me to speak to that.
Or Tracy.
Yeah. So, yeah, Tom and I actually need to circle back and discuss some of that a little bit more. And I believe there was still more of the document that we needed to go through. If I recall, we ran out of time and then we scheduled another time, but I still think there's a few things more that we still need to discuss. And so, Carrie, if it's okay with you, if you could send me some times and dates, maybe in the next week or so, that you might be available. And Jeff and Laura, if you're available, that would be great, and we can finalize all that and move forward with that. Okay, perfect. Sounds like a plan. And I'll get those dates and times over to you. Okay, thank you. And so most of you probably remember Mark Stroud from our investment team, director on our investment team. He was actually, when we had our last meeting, last annual meeting, because I know that some of us have met since, it was late February. We were all in person. Mark joined David, Roger, and I for the investment review. And so we invited Mark back to talk about a few things. He's going to give some market commentary. He's also going to speak directly regarding the fund performance, and in particular, anything that may be on the watch list. And then certainly be available for any questions that you may have as it relates to just the overall lineup. So I will go ahead and turn it over to Mark, and then from there, Roger will get into some of the plan specifics and talk about what we're seeing
in terms of the demographic data and plan health. So Mark, I will turn it over to you. I know that I'm going to be navigating some of your documents. So if you will just tell me which one you'd like me to put on screen first, I'll go ahead and get that up for you.
All righty. Hello, everyone. Can you hear me okay?
Yeah.
Well, good to join you again. And boy, it's been an interesting 15 months, huh? Wow, since I saw you last. We certainly had a roller coaster with the economy and the markets and the pandemic over the last 15 months or so. The economy is recovering, as most of us have heard, as people are getting back to work, starting to shop, spend a little more money, and the gross domestic product figure, which measures overall economic growth, was up 6.4% in the first quarter. Obviously, the stimulus packages that we have heard about and experienced have helped that quite a bit. Over in the financial markets, we had probably the quickest bear market ever in early 2020, and a dramatic recovery since then, with the S&P 500 index, broad measure of U.S. large cap stocks, up 18.4% total return for 2020. Year to date, it's up 11.8%. Certainly hasn't been a smooth ride. There's been some volatility here and there, but overall, certainly nice gains this year also so far. Foreign stocks, as you know, many of the foreign economies are slower to recover, different rates of recovery from the pandemic and economically, but many markets overseas have bounced back. Year to date, the overall measure of foreign markets and the CIEPA index is up 9%. What we're going to see as we look at returns, whereas large cap stocks did very well last year and had a big run, especially in technology, small and mid cap stocks have started to do well over the last, say, 6 months. Also, when you look at that size, when you look at value versus growth was very well received last year, and those were the strongest gains. They're starting in the fall, value stocks and mutual funds started to bounce back. So those have actually outpaced over the last few months the growth stocks, which is unusual. Also, looking at sectors, energy, financials, and materials have done very well. They've outpaced technology over the last few months also. So we've really done a flip-flop on the stay-at-home stocks that were popular last year to some of the more stable stocks and sectors right now. Over in the fixed income world, as we saw the financial markets drop, stock market drop, fear early in 2020, interest rates went down. When interest rates fall, bond prices went up. So there are good gains last year for fixed income. Again, a flip-flop, interest rates have started to rise this year, and the overall measure of fixed income, Bloomberg Barclays aggregate index is down 2.6%. So on some of the bond mutual funds, we're going to see some negative returns. Looking forward, a lot, of course, depends on the recovery from the coronavirus. We've made some great strides in the United States with vaccination and people going back to work. So we're going to continue to look at things like employment and recovering the economy in different sectors that were really hurt last year. Household spending has increased. But a couple of things that investors have been worried about earlier this year are inflation and taxes. A lot of things, I don't know if you tried to buy lumber lately, but it's just astronomical price increases along with other things. There have been supply chain problems, shortages that have led to price increases for a lot of different sectors. Another thing is, as Washington talks about increasing taxes, investors get a little nervous of that. Of course, tax packages are generally hard to pass. So I guess the bottom line here is we'll probably continue to see some volatility this year, but underlying the economy and the corporate profits are looking pretty good. Any questions? I know that's a little bit more than you wanted, but want to give you the overall picture, kind of paint the background.
Mark, I
Yes,
have a
sir.
couple quick questions. The rotation from growth to value, how much more run rate does that have? That's the first question. And the second is, does AIG see the inflation as transitory and singular, or is this the beginning of an upward trend?
Okay, part of your both questions is kind of asking for a prediction, which is tough. But the value, as you know, has been lagging growth for years and years. So it's unusual to see it pop back up into prominence. But it kind of makes sense as you see the economy recover that sectors that have been ignored or have not done well for quite a while during the pandemic are starting to recover. You know, I mentioned energy, which was really wild last year. Financials, as we see interest rates do better. So a lot of these value sectors, utilities, are doing better. And it seems to me, based on what I read and what kind of makes sense, is that the value over outperformance seems to have legs, at least for a while. You know, if this, and as you know, things can go to the extreme. If everybody piles in the value, you know, growth will suddenly become cheaper, you know, and then you could argue, are the former growth stocks now at good value? So certainly more to come, but it seems like based on what we're seeing with the economy opening up, the value has some more room to run. And as far as the inflation, it seems like some of the fears have died down now. We're certainly not getting rampant inflation. You know, as I alluded to earlier, it's, you know, there's certain pockets of the economy that, as you mentioned, housing, but of course that's related to both demand and also to just supplies for builders right now, and inflation there. So certainly, and of course, as an economy opens up, you know, inflation always goes along with economic growth. So if you have some thoughts, certainly like to hear them, but that's kind of what I'm thinking now.
No, just wanted
Inflation,
to
but not
get your thoughts on it.
Yes, sir.
Just wanted to get your thoughts on, particularly whether it was a one-time supply chain transitory environment or whether this was the beginning of an
Some of these shortages. Yeah, sorry. Some of these shortages are going to continue, so we're going to see inflation certainly in some areas. Okay, thanks. Any other questions before we move on? I want to mention, I apologize for not bringing this up before. I brought along another member of my team, Jessica Dean, Senior Investment Analyst, who's going to be working with me to help you out today. Carrie, if you could move to the PDF document, the large 27-page one, monitoring report, and just start with page 4. Very happy to hear that you're all working on the investment policy statement. That's the best way for us or anyone to monitor your investment lineup based on what is important to you. What we've done, without having that yet, of course, is use standard VALIC monitoring criteria, and that's on page 4, Carrie. And basically what we're doing here is looking at performance, risk, and expenses. When I say performance, it's the 3-year and 5-year ranking. That is, how is the fund doing among its peers in the Morningstar database? The overall rating, the star rating, many of you have heard of that before, going from 1 to 5, 5 being highest. The star rating takes into account both performance and risk for a mutual fund. And then expense ratio. We want to see funds that are in the lower expense level of their category. And if you could just back up one page, please, Carrie. What we do with those 4 criteria is take the last 8 quarters and come up with a score for each fund. So if a fund has passed those 4 criteria over the last 8 quarters, 70% of the time we say it passed, and if not, it failed. Now, the three funds that Jessica and I want to talk about today that did not pass. So if we could continue to the performance pages, please, Carrie. And we get start with page 6, the 6th page of the document. What we have here, and I think most of you've seen this format before, but what we're looking at is all the funds in your lineup, and what we show is performance in each in many periods, 3 months all the way to 10 years. And next to the performance percentage is a ranking. That's how well this fund did in its category for that period of time. So, for example, for the 3-year annual rate, performance 11%. That's in the 38th percentile in its category. So low numbers are good when we're looking at these. What we did is I averaged up all the 3-year and 5-year rankings because we emphasize long-term rankings. The average 3-year ranking is 44, average 5-year ranking is 42. And the average expense ratio for your lineup simple average is 0.78%. Okay, as we look at this, if you see this, for example, in large cap growth, this number highlighted in green, 67%. That means that is a criteria that did not pass among the 4 that are monitored for this fund. As you can see, this fund still had a 90 score. Okay, 3 funds hit the watch list this time, and Carrie, if you could please advance to the next page. I believe that's where we started. Yes, with the 3 that are on watch. Okay, second one down, American Century Real Estate, and Jessica is going to help us understand that.
Hi, I'm Jessica Dean. It's nice to meet all of you. So overall, I would say the lineup is very well diversified, and the funds have been consistent performers. As Mark said, we do have this criteria that helps us monitor, so we can keep an eye out and maybe make some changes if a fund consistently is put on our monitoring report. Regarding the American Century Real Estate Fund, this one overall, the main dig against it, I would say, would be the expense ratio is a little bit, higher than the category average. And because of the emphasis on expense ratio in our monitoring, that has kind of held it back. But year over year and in the last 8 quarters, it's only performed in the bottom percentile a few amount of times. I would continue to monitor this fund. I don't see any major red flags. As Mark's probably stated in the past, if there's, if you ever want us to provide alternatives, we can. I did have an opportunity to go over fund options that meet the revenue requirements with this fund, and there aren't any funds that in this category that provide the same revenue with a lower expense ratio and better performance. So as I said, since that's the case, we'll continue to monitor this one. Unless you would like us to provide candidates, we can do that. In regards to, Mark, did you want to go next, or would you like me to cover the American Funds Euro Pacific?
Yeah, will you please cover the Europac? Okay.
So in regards to you'll see the foreign large growth American Funds Europac. Also not concerning, this fund has very strong history. It's also turned around quite a bit. I looked at the Morningstar analyst report. It's rated as a silver fund, which means they definitely consider it above average. It's turned around recently. I wouldn't expect it to stay on the watch list. So this fund, again, I would continue to monitor, not make any adjustments, but if you would like, as we said, we can provide candidates.
And a question on this in terms of a 3-month total, most the trailing 3 months, is that the impact in terms of returns part of that larger growth to value recycling that's taking place?
I'm sorry, what was that?
The negative return in the trailing 3 months, is that because it's large growth, is that impacted by the cyclical rotation that's taking place out of growth into value? Is that temporary, you think?
I would think the shorter term numbers are definitely temporary due to the major market volatility within the last year. Mark, would you want to add to that?
Value has definitely outperformed growth. Another aspect here is this fund tends to have more emerging markets exposure than some others, and emerging markets
they're behind us,
kind of follow.
and they're behind us in recovery.
Yes.
Right.
Okay.
Great point.
Thank you.
Sure.
Anything else on that one?
Unless somebody else has a question, I'm happy to answer.
Okay, well, let me move to PIMCO total return, the one that we're more concerned with. This fund has been a watch the last 4 quarters. I believe when I talked to you, it was the numbers were pretty decent. But basically, when our team sees a fund that's on watch for 4 quarters, we bring alternative just in case the plan sponsor wants to make a change. Part of the reason this fund is on watch over this period is because of the expenses. So it got hit because its expense ratio is higher than the category average. It's been a little inconsistent. For example, last year it finished in the top half, but again, it's in the bottom half for year to date. It's a very large fund. If some of you are familiar with it, all this is the Bill Gross Fund, who is now left this, of course, and moved on and is managed by three fund managers now. They've done a decent job, but again, it's been a little inconsistent. So what I've done is, in case you want to look at candidates for a change, we brought 4 or 5 plus some fact sheets. But it was mentioned earlier you don't have a quorum, so it's up to you whether you wanted to start the discussion or save it for another time.
What does everybody else think? Maybe a way forward would be if we could have those forwarded on to us and we could discuss it next time we have quorum in our business meeting. Any thoughts?
Yeah, suggestion, Tim, you're in the next meeting is what, 3 months away?
It would be, when would it be? July, Tracy, I believe? Or August?
It's scheduled for August 18th, and we have had special called meetings in the past if we need to have one for them.
Given it's 3 months out and the market's in flux in terms of these changes, it probably makes sense to get updated performance numbers with new trailing 3 months closer to the meeting.
Makes a lot of sense.
Is that something that could be sent to the board?
Yeah, Commissioner Denson, Carrie sent hopefully to everyone the Excel spreadsheet with the candidates and also a PDF file with fact sheets for both the PIMCO fund and the candidates. I believe it's in the meeting invite too. go.
Yes, Laura did attach it to the invite.
Thanks, Laura. Very, very efficient for there. Okay, is that kind of the consensus? We'll bring this up at a future meeting and just watch it.
Sounds like everybody's good with that. Yeah, we'll just consider in August instead.
With
Okay.
updated data.
Yeah, if we
We can rerun it.
Okay, well, the performance continues, and the last one on the list is the fixed interest option, and just wanted to remind you it's paying a very robust 3% crediting rate. At least that's what I kind of. Carrie, does that sound right to you? I believe that's it.
Yeah,
Yeah.
that is correct.
Okay. Okay. In this environment, that's a very attractive rate. And one more thing, Carrie, if I could make you work to go to page 26.
Okay.
Jessica mentioned earlier the diversification in the lineup. She and I have worked with some groups in the past where I guess there's some challenges in those areas, but yeah, I wanted to point out, especially on the left, all the equity style boxes are filled with at least one fund. So very happy to see that. Over on the fixed income side, it's not common to have a bunch of them there. So I think you've got great exposure to fixed income also. I guess the only other thing I want to mention, I certainly don't want to take up the whole meeting, but we brought up the idea of perhaps looking at target date funds as a QDIA. I think that discussion probably would make sense for a separate meeting, or to tack on to a longer meeting. But we certainly want to remind you that we're thinking about that. Wondered if any of the committee members had thought about it any more since our February meeting.
And Mark, if you wouldn't mind, I think it would benefit the committee for you to just give maybe a quick overview of the target date funds and their purpose, and maybe talk a little bit about the glide path and so forth.
Sure, Carrie. Yeah, just as a reminder, and I realize not all of you were at the February meeting when we brought it up, but for QDIA, the default fund or funds, my understanding is it's currently the fixed account, and kind of based on what we've seen in industry best practices, we often see a different investment used for QDIA, the default fund. And it's generally either a balanced fund or a suite of target date funds. And I'm sorry I don't have an illustration with me, but let me try to describe it. A target date fund is kind of like a balanced fund where it has both fixed income and equity in there. So its underlying components would be fixed income funds and equity funds from a provider like T. Rowe Price or American Funds or something. Okay, so the fund would have fixed income, some cash, and equity. And you have a whole suite of them. So, for example, there's a 2065 fund. And that would be for your younger participants, of course, who are estimated to retire in the year 2065. That would be a very aggressive fund. So it would be mostly equity. The idea being a younger person it makes sense to have mostly equity in the earlier years. On the other end of the spectrum, as you get toward retirement date, for example, a 2025 fund, that would be very conservative. That would have a majority of fixed income and a low percentage equity. So the idea here is kind of a one fund to get the diversified portfolio. And so you would have, for example, the 2065 all the way to 2025. And most of them actually have a retirement income fund as part of the suite. And so someone who's actually retired may stay in that target date fund because that will generally get more. So as you go what's called the glide path, from the most aggressive to the least aggressive at retirement, the portfolio gets more conservative. And that kind of makes sense as you go through your career path. You probably generally want a safer, more conservative portfolio as you approach retirement. So one big benefit is with one fund, you have a diversified portfolio. So it's really good for someone, for example, who doesn't have the ability for one reason or another to meet with a financial advisor. They can make one investment decision and have an instantly diversified portfolio, and it gets more conservative as you get older. So many plan sponsors that Carrie and I have worked with have adopted these for QDIA, and it's certainly up to you, but we definitely want to bring this to your attention again as a maybe better alternative for your QDIA, for your default fund. Carrie, would you want to add anything to that?
Yes, but first let me get off of double mute. No, I would just reiterate what Mark said in the beginning about best practices as it relates to the target date funds. And we do have the ability, if it is set as your default in place of the fixed account, we do have the ability to have participants or employees enter into the plan and default them by birth date, right? So that's something that we can set up automatically and make that a really smooth transition. There's no guesswork around who should go into what fund. We have the indicative data from your files, and we're able to just place them into the target date funds accordingly based on birth date. So something we just wanted to keep on your radar. I'm sure as you have continued conversations with Aon, you'll probably hear this again, and I wouldn't be surprised if they didn't make the same suggestion.
So just a question, in your model, I can have, as an employee, I can have some of my equity in diversified funds that are individual in nature, large cap, small cap, et cetera. And then I can put a portion in that targeted as a risk, basically either as an accelerator to risk or as an offset to risk, because every one of those funds is asset allocated and balanced within itself. And the thing that makes them different is the level of risk that's required. So I don't have to put everything into that under your plan. If that were options available, I could put a portion of my equity in there and a portion in the other available funds, correct?
Absolutely, that's correct, Mr. Slimer.
Got it. I mentioned that because I have some things of my own that are in targeted funds that I'm utilizing now as a risk offset. Okay, I got it.
Okay, that was all I wanted to cover, and appreciate your attention. If there are no other questions, I better pass it back to Carrie.
Thank you, Mark. And then I am going to, I know that we have about 45 minutes left. I am going to pass the baton to Roger, and we will get into the specifics of the 457 and the 401A plan.
All right. Well, thank you very much. And I will say the same things you've heard a couple of times. I am very excited to see so many of you from last year, and looking forward to the day we can all get back together in person. So let me share my screen here, and I'm going to start to set this up a little bit as to what I'm going to go through. I've got a what we call the plan review, and it's got a lot of numbers in it. It's got information on how your employees are investing. So I'm actually going to bounce around a little bit in here. And Carrie, can you see that on the screen? Am I good there, or is it up? We're good to go.
See it, Roger. The only thing I might ask is if you could maybe just blow it up a little bit. Make it a little bit large.
Let me see if I can get this about there.
And that's probably mostly for me. But
okay, got it. All right, so Carrie has now got the screen large enough for her to see everything, so we're good there. All right, so what I'm doing here, again, I'm going to bounce around a little bit, but there's a reason that I'm going to do that, and I'll try to make this all connect in the right way. So the page you're looking at right now is really the culmination of 3 different plans that you have. Most of the assets in your this combination here come from the 457 plan. 457 is where all of the employee contributions go. And then you've got 2 401A plans, and that's where all of the employer contributions go. One of those receives the matching dollars, and then the other one receives the management plan dollars. So want to give you that backdrop before we get into this. So if you're looking at this screen on the right side, in all 3 of those plans, $67,390,000 was what we had in there as of 3/31. And right below that, we had total active participants. Actives are defined as anybody that put money into the plan during that 12-month period that we're looking at, which in this case ended the first quarter of 2021. Left side of that screen, you've got total contributions into all of these plans in that year of $5.2 million. Some money rolled into the plan of $267,000, and total distributions. Now, this is all money going out, but keep in mind you've got a lot of retirees still in this plan. So a lot of people save in this plan, they retire, later they begin to draw money out. And so this is going to include retirees, people leaving. Any money coming out was $4.4 million. And then I'm going to get into the enrollments in a second. You'll start to see a breakdown of how those have looked over the last 3 years. But that's the big picture. Now, I am going to jump way down the line here. If you're following along on something else, I'm going to go to page 24. And as soon as I get there, I'm going to explain what we're looking at there. All right, so let me go back. And you're getting a preview of some of the things we're going to talk about here as soon as I can find the right page. And bear with me. I think because I blew this up, it's taking a little bit longer. And, you know, Carrie, I may go back to 100% just to make sure I don't mess this up, and then I'll get back to another.
No problem.
All right, there we go. All right. Is that large enough? Should I expand it out again? Is that okay? A little bit bigger. Okay. All right, let's go back. All right, and I should be able to move through this fairly well now. All right. So what I've done is I've jumped ahead, but what you're looking at right now, you'll see $53 million. This is the 457 plan. Now I'm going to spend a lot of time on the 457 because the other 2 plans, the 401A plans, are going to be very, very similar in the patterns that I'm about to show you. And this is roughly 80% of all the assets of all 3 plans are here in the 457. So once you've gone through these numbers, you're going to have a pretty good picture of everything that's going on within all of the plans. And you've got a 3-year track record here to look at, and I'll focus you on the very top line there, total plan assets. 3 years ago, they were at 42 million. These numbers happen to be the end of the first quarter of each year. So 3/31 of 20, you remember, market was in a terrible place. So not only did we not have growth, we stepped back a bit, but then you fast forward to the spring of this year, and we're up to 53.7 million. You see the same thing with active participants. We had running about 14, then up to 1,500 actives, and then we pulled back down to closer to 1,300 actives. And what goes along very closely with that, if you look at the very bottom of that page, we have an auto enroll here. So as new people are coming in, they're automatically put into the plan. And we've been averaging the last couple of years, low 200s, around 200. And last year, of course, that dropped way down to 123. So we had some impact from everything that was going on in COVID-19 and 2020. But overall, the markets have rebounded for us, and things have seemed to have stabilized a good bit. But that's the first page I wanted you to be aware of. The second page is a 3-year track record of, and I want to focus on the top 2 lines specifically. So you've got participants with a balance, and right below that, active participants. And if you remember, active participants are those people that have put some money into the plan in the last year. Participants with a balance are the actives plus everybody else, everybody that has not put money in the plan in the last year. And that's where a lot of your retirees are, or potentially people that have left the organization and just haven't done anything with their plans. And you can see those account values, same things that we looked at a second ago. The overall count, number of people, 1,665, 1,775, 1,839. Total number of people in the plan continues to grow. And of course, your active slipped back a little bit. You don't have any loans offered in these plans, so that's all going to be zeros across the board. And then at the very bottom there, you've got guided portfolio services. Many of you are aware of this. Some of you may not be familiar with it. That is a managed program that employees choose if they want their portfolios managed for them to go towards a specific goal, specific ages, and so on. And that stays pretty steady. You can see the market helped us out a good bit last year or the last 12 months as things have come back. But that's a little bit deeper snapshot of the 457 and how everybody is allocating there. Now I'm going to get a little bit more detail, and this is your actives and your total participants as we talked about before, but now it breaks it down by age. Auto enroll has really helped this plan a lot. I see this in auto enroll plans. I get to see plans that didn't have it, and then eventually, as time goes on, you start to see almost a parity across all of these. You still have a lower participation of people. I'm looking at the left side here. Active participants under age 30, about 18% of the total employee population there that's in the plan. But then if you look at people in their 30s, their 40s, their 50s, fairly close. A lot of times, if you don't have auto enroll, that number is going to be very skewed. And then you see a big drop off, which you would expect as people get over 60, people begin to leave, retire, and so on. The numbers on the right side of the screen, they're just bigger numbers, but they're very similar as percentages go. You can look across that. It's a very similar pattern across all of the employees. So you've got, and this could be a lot of demographic data from which, this is what your employees look like across the board. But at the end of the day, you've got a very about 75% of the people participating in this plan are in that 30, 40, 50 range. And then it kind of drops off on the ends a little bit. All right, next slide. We've got the average account balances. They're running at 29,000, and that's going to range from people in their 20s, average account balances of 4,400, people over age 60, averages of 52,000. So right in between there, $29,000, $30,000. And your average contributions from your employees, low end of 1,400 for people in their 20s, and then you get up to about 4,200 a year from people over 60. And those are normal patterns. Obviously, you're going to expect that as people move through their career. And as they get a little bit closer to retirement, the idea is they're saving a little bit more, earning a little bit more, a little more focused on maybe increasing their contributions, make sure they're in line for when they're going to retire. Yes.
This is Jeff. Can I ask a quick question?
Absolutely.
We're seeing that between sort of our pension offerings and savings rates, a little bit of a shortfall for employees as we project those things out. Is there, and I thought I heard you mention something, is there benchmark on local government or public sector employees for what their average account balances or contributions look like as compared to what we have here? And maybe we could get some feedback on that in y'all's view as far as how these participants are doing and what messaging and additional financial wellness we might need to be doing to share those things with them.
Those are fantastic questions. So a couple things. One, we can always provide data that shows national averages, benchmarks. That's something we can always pull together for you. It varies a good bit. Depends, you're doing a matching plan, and those can vary around the country. And there's all kinds of things that come into play like that. Now, the question is there's two more parts here. The question is to whether or not a person's on track. Very much depends upon those specific goals of the individual. We have some people that say, I want to retire at age 50 and I want 100% of income and I'm saving $25 a pay period, and it just isn't going to get them there. And then you've got other people that have a more reasonable goal. And so what we try to do, and this is where David comes in a very important role. And you're going to see some of the numbers on how they're investing in a second. I'll talk more about David and what he does. But a lot of what his process is to show people, if you save a certain amount and your employer puts in a certain amount and you're here X number of years, here's not only the amount you're going to have, but how long will that last depending upon expenses. And we have the tools to be able to show them that. And I know you've seen that. And that has been by far the most effective way. Now, the other piece that you just asked is also a very, very important question, and that is financial wellness. And how does that play into a whole picture of other types of there's health wellness, there's financial wellness, and so on. And this is a very, very important piece of that picture. That's usually a combination of things. Understanding the need is one. So when you get into the communication side, and this is where we absolutely can help with either material and or workshops with the employees. And I know David's done a number of these in the past, but getting employees involved, whether that be on a WebEx, which we've done, exclusively here for the last year, or in person or both, and getting across to the individuals that there is a need, they need to do something here in order to make sure that they're going to have a comfortable standard of living when that time comes, they're ready to slow down, retire, whatever happens to be. So there are lots of things that I know we've worked with you in the past, and we can continue to ramp up communication materials, workshops, one-on-one meetings with the financial advisor. That combination is pretty powerful. And you've done a great thing a few years ago. You went to auto-enroll. Without auto-enroll, a lot of the employees that are in this plan right now would not have signed up. And it's not that they didn't mean to. It's just, they forget. They have good intentions. Like all of us, we get busy. And you've got people now that are beginning to build that financial security. So that was a big step that you took.
Roger, quick question. Does AIG as a tool for participants have a standalone calculator that's kind of self-guided that combines dollar cost averaging with compounding so that they can do their own math and begin to explore that themselves? Sometimes people are afraid to say, I don't know.
Absolutely. That great question. We've got two avenues for employees, because you're spot on with that. Some employees are going to prefer just to go online, do their own work, and then they're going to be set. Some are going to want to start that way and then maybe reach out to David and say, okay, I want to take a step further. And then some people are going to go directly to David and say, all right, I don't have the time or the expertise here. I need your guidance. So we try to cover all of those bases. And we have what we call this tool Pathfinder. It came out a few years ago. It's continued to be improved year after year. And so we rolled out a version of that for our participants. In the past, it was exclusively with the advisor. And the advisor's version is more complex, a lot more options there. And then the version for employees now, we've had other calculators in the past, but this is the most robust tool that we've put out there. So in answer to your question, absolutely. And there may be, tying back into Jeff's question, there may be a great opportunity there to educate everyone on, you've got this tool that's out there. You've got the financial advisor who can meet with you, or a combination of the two, whatever that you would like to do. So you do have some very good resources.
Roger, this is Tracy. If I can just interrupt for 1 second. I do just want to let everyone know that through the wellness program, we have added a financial wellness component to the WELL, so that when people do attend any of the healthy hours or programs that David provides, they get credit for that. They're also able to get credit for doing things such as setting a monthly budget, meeting individually with David, setting a savings goal and reaching that. So there are several different ways that we incentivize people kind of taking control of their finances and being more involved. That is something, though, that we could probably promote a little bit better. So perhaps at some point, David and I can get together and talk about having more of a concerted campaign to really focus on financial wellness and push that to make sure that people are aware that they can get credit through the WELL for being involved in those activities.
And Tracy, if I could just add, as part of our website, AIG retirementservices.com, we do have a very nice education tool called Future Fit University. And there are a ton of different modules, articles, activities that participants can actually go in and participate in. And one thing that we can do, provided that they tell us that, you know, they are an ACCEG employee, we can actually track that activity for you. And what we've done with other clients that have wellness programs is that we can then tell you who's participating. And that may be another avenue for you to, you know, award different points and things like that for actually going out and engaging in some of the retirement readiness tools. So just a thought.
That'd be great. Thank you.
Okay. So we can, we'll talk more about that offline.
That sounds great.
Good.
Okay.
So I did move to a new slide, and this one just give you a little bit of a picture of where the money is going by if it's pre-tax versus Roth. We do have a Roth option in your plan, and most of the dollars continue to go into the pre-tax investments, but you can see about $886,000 on the Roth, a little bit of money rolling in. So on the right side there, $4.1 million of contributions, distributions at 3.4. Net cash flow, if you just exclude the returns or losses in the market, net cash flow there of about $750,000. So wanted you to be aware of that bigger picture.
Roger, do those distributions also include ex-employees who have rolled over and rolled out?
Absolutely, yes, it does. Yes.
All right.
Got the total picture there.
All right.
Now this page, this one's always a very fun page to look at because it's going to break down by age how your employees are investing. And I love to watch this because if you look at each one of these boxes, you can see the first one there is under age 30, then it goes 30 to 39 and so on, tells you the number of participants that are in each one of those categories. And then it breaks down for you as a percentage where the assets are. Now, the one thing I always focus on right away is that green area, which is your fixed income. That's going to be the fixed account, which is what your default is. You had mentioned that earlier. And then you have you got bonds, you got money market, anything that's stable, fixed income in that category. And I'm going to come back to under age 30 in a second. If you look at 30 to 39, and if you look at the bottom of the list, it'll say fixed income 12.7%. And then in the 40s, it goes to 16.1. And then you go to 50s and you go to 60s. And that's generally the pattern we're going to expect. We're going to hope that the employees earlier in their career are going to be more diversified in areas that give them a lot more opportunity for growth. But then as they get closer and closer to the point that they're going to use the money, that they're going to become more conservative, at least with portions of the portfolio, so they can protect that piece. And that's a gradual process, very similar to what everyone talked about on the target date funds earlier. Now, one thing, I'm going to go back to the less than age 30 group, because you'll notice the fixed income at 26% is a little bit higher than the 30s and the 40s. That's a little unusual, but because you've got a default of a fixed account when people are auto-enrolled, this actually tells a good story. What it's saying is that everybody that was auto-enrolled initially was going into the fixed account, but the majority of them, and I've talked to David about this earlier, the majority of them are meeting with David, and David is discussing everything that we just talked about here, and people are diversifying that portfolio. So while it's a little bit on the high side at that point, I think what's happening is you're moving a lot of people into a diversified portfolio from the default. And it does swing back to what you talked about earlier. If you have a target date as the default, then you're going to see more of that hybrid, that dark blue right in there at 4%. That number is going to start to increase significantly. And then people, again, can, as was asked earlier, they can diversify it outside of the target date. That's simply the default option. So either way that you're comfortable, it's something that we can, or I know you're going to consider.
It would be
Any
fascinating.
questions?
It would be fascinating to look at the asset allocations around target dates as you recommend them, or the thing, and overlay those against the actuals to see where the variances are.
Yeah, as far as those allocations and
Exactly.
yeah, comparing.
Mm-hmm.
I'm not
we
sure.
may have some age groups that are already in the aggregate on target and some that are way off.
Yeah. I think you're right. It's probably going to be all over the board. Mark, that's probably, I don't know if Mark's still, oh, there you are. Mark, I don't know if that's something we can do or take a look at, but, or if you've seen patterns like that before.
That would be interesting. You're saying to just pick a target date suite, look at the allocations, and compare it with these age groups.
Exactly.
Mm-hmm.
Exactly.
Yeah, that'd be an interesting exercise.
And it also may be a way to sell the target date as a product back to the end employee.
Interesting. Okay, we can take a look at that.
I'm going to go back to one more page. I'm going to go actually 2 more pages. Bear with me. It's a little bit slow, but I want to jump over to page 7. And this is just going to give you a quick snapshot of the other plans. The other plans, now that you've seen the 457 when it comes to the investments and the patterns and the year over year, these numbers are going to be almost identical, just obviously different because they're a smaller portion of the overall total. So here's your 401A plans. Total assets in the 401A is now up to 13.6 million. And these patterns are exactly the same. If you look at the bottom there with total enrollments, the drop off, all of this is going to be the same, including, again, those investments. I looked at those earlier, and those investments are awfully close to the same thing, which makes sense because your match obviously is almost always going to be the same thing. So not much deviation there. There's one piece though I'm going to show you, and then I'll wrap up here. And it's not a numbers page, but I think it's worth us showing you, and that's a little bit about a national survey on the financial advisors. I know you all know what David does in pre-pandemic, post-pandemic times. He's on site pretty much every day working with your employees. We did do a survey, independent survey, 2,000 participants around the country, so fairly large number. And we asked them 3 questions here. Number 1, are you satisfied with your advisor? The answer here was 90% yes, and 76% said very. Do you agree they're valuable resources in making decisions? 86% said yes, 72% strongly agree. That's important because that's a big goal for us. We're trying to just help people make some smart decisions as they move forward, give them the information that they need. This last one actually falls into place with what we've just been through over the last 12 to 14 months. And that is, do you agree the guidance has helped them manage through uncertainty, which clearly that has been the case. I have seen this, by the way. I've been with the company a long time. I've seen it 2000, 2001. I've seen it 2008. Every time there's a crisis financially out there, your plan becomes very important in the eyes of the employees. So if we can guide them through during those times, where our objective there is to make sure that your plan is not only, we know it's a quality plan that you've put together, we want to make sure the employees understand that as well. So I wanted to pass that on to you because I mentioned earlier that it's pretty clear David's meeting with a lot of people, making sure they're well diversified. But I also wanted to point out on a national scale, there is a lot of value there that it's hard to quantify sometimes, but we do have something we wanted to show you. So Now, with that, that is all the slides that I have here, unless you've got some other questions or items that you want me to cover. Okay, so Carrie, I don't know if I'm throwing that back to you or.
Yeah, I will take it back. And the one thing that I'll close with, and just to give everyone a heads up of what's on the horizon, you've probably heard or maybe even read about the Secure Act 2.0, right? And while we don't have any formal communication at this point, because honestly, there's still bills floating around on this topic, and they aren't necessarily moving quickly, but I did want to give you a heads up of what's coming down in regards to Secure Act 2.0, most of which will not affect your plans. They're primarily around 401k, 403b, simple IRAs, but they've really kicked up the Secure Act around three main focuses. One is, incentivizing people to save more, improving retirement plans, and then lowering costs for employers. And I won't spend a lot of time on that because that's primarily around smaller employer 403b plans. But just for you to get a sense of, what's on the horizon, some of the things that'll be coming out will be, eliminating the RMD in some cases based on the participants' retirement plan assets. And what it's saying right now is that anyone with plan assets under $100,000 would not be required to take a minimum required distribution. They're also looking to delay RMDs as well. There's also some legislation around, improved enhancements around student loan debt and things like that. And some people have said, well, why are you guys talking about student loan debt? We do have a student loan program with Savvy. And the reason we do that too is because if there's some opportunities for folks to divert those funds that they were paying on student loans into retirement savings, then, we obviously want to highlight that for our participants. And so, a couple of other things that's coming down with Secure 2.0 primarily for 403b plans, and again, wouldn't necessarily affect you, but they are actually looking to expand auto enrollment, which you are already doing. And then, the last thing that I'll mention too, outside of the retirement plan realm, is that this act is also looking to beef up the savers credit, so that would move from $1,000 to $1,500. But as we get more information and more guidance on Secure Act 2.0, we will be sure to relay that to you, and how that would translate to any actions that you might need to take on any of your plans. And then certainly from a participant perspective, if there's any communication that we need to provide to participants, we'll be doing that as well. So just wanted to put that on your radar. As things firm up from a legislative standpoint, we'll be sure to get you more information.
All right. Fantastic. Thank you, Carrie. Thank you, Roger, David, Mark, Jessica, everybody for that. That was very, very helpful. And so at this point, did anybody else have any questions for them, or also any other concerns or comments you want to bring up here at the end of the meeting? All right, fantastic. Well, so for the at our next meeting in August, I guess we'll be considering possibly looking at alternatives for the one underperforming fund, and also bringing on our new board members. So that'll be a nice active meeting. If nobody else has anything else, I'll move that we go ahead and adjourn. All right.
All right.
Fantastic. Well, thank you everyone for being here, especially all of our special guests and Dennis, and we'll see you next time.
Thank you very much.
Thank you, Commissioner. Thank everyone.
Well, take care.
Thank you.
Bye.